Very good morning to all of you. So, let us begin our today's session. In our last session, the last week, we were discussing regarding the financial function, and we had discussed regarding four different types of financial functions that would be normally done under any of the business scenario, and we had divided those four different types of business decision into two different kinds on the basis of time, that is long-term financial decision and short-term financial decisions. Now, speaking regarding long-term financial decisions are the ones which would usually involve a longer time horizon, usually maybe more than 1 year, 1 calendar year. That is to tell, usually the accounts would not be closed down at the end of the each financial year or at the end of the profit and loss account. It would be carried forward for the coming years. And also that we have to remember that the investment that would be done, to take this financial would be always involving a high amount of investments. Okay. Now, long-term financial decisions are those which would be affecting the performance and value of the firm in particular. The better the decision, the better would be the performance of the company, and when the performance of the company would going to be better, definitely the value of the firm is going to increase. The value of the firm can increase in terms of goodwill for in the eyes of the society, and also in terms of its value for the shares in the market. Yes, and definitely whenever a company has to take some decision regarding this long-term financial decision, definitely the higher management would be involved, and the majority of the decisions would be taken by the those people of the organization who are in the top level management, because they are the ones who are answerable for the investors, and it is the investors money that the company is going to use. Regarding the investment decision, we had already discussed during the initial days when we started discussing regarding SFM, but even then I would briefly tell regarding the investment decision, so that if at all you have forgotten, you can easily brush up things. Now, a firm's investment decision always involves capital expenditures. Now, since it involves capital expenditure, it is also named as capital budgeting decision. And whenever we speak about this capital budgeting or capital decision, we should remember that it involves some decision that has to be made in terms of how you are going to invest the money that you have in your hand for the disposal. And all this commitment of funds would definitely be for a long term of period. Okay, and also that the investment would be made in such a way that the benefits or the cash flow we are going to get in coming future. Now, there are two important aspects that we'll always have to remember regarding the investment decision. The first one is we'll have to analyze regarding this decision in terms of how much profit will it going to bring to the company. Okay, and the next one is, you will have to measure it in terms of the cutoff rate. Now, cutoff rate would be against the prospective return of the investment in the future. That is to tell, how much will I have to bear the expenses today and what would be the rate of return, or how much am I going to get tomorrow. Now, this expense and expenditure should match in the sense that the return what we are going to get should always outrun the expense. If that is not going to happen, the decision that would have been analyzed to take on would be dropped down. Now, in other words, the investment decision is also called as long-term asset mix. Regarding that also we have already discussed. Yes. Now, future benefits of investments are always difficult to measure, uh, because in accounts what happens is whatever transaction has been done, we do tend to record those. That is called as historical method. Now, in what might happen in the future, we can never tell in exact terms. We can predict, we can be ready for that, but we can never tell it in exact terms. So, future benefits of investments are always difficult to measure and can never be predicted with certainty. Now, whatever we speak about this risk, the risk in the investment definitely arises because of the uncertainty in the returns, or the unknown factor for us to know what would be the exact return. So, it is, you know, always uh, said for the investors that these investment proposals, or whatever idea they have regarding the investment, it should be evolved in terms of both expected return and also the risk. Now, besides these decisions to commit funds in the new investment proposal, this capital budgeting also involves something called as a replacement decision. Okay. Now, investing is you newly invest. Now, replacement decision is that now you might have already invested somewhere. For example, you might have invested on a machinery. Now that machinery might have become obsolete, or it cannot be used anymore. In that case, what happens is you'll have to take back whatever you have invested and you'll have to reinvest in a new machinery. That can be said as one of the example. Or maybe you have invested in a new product line. Now, that new product line might seems to be less productive, or it might also seem to that it is taking up much part of your profit. So, even during those times, you tend to change your investment decision. So, this investment decision can also be regarded as a replacement decision. Okay. Now, speaking about this required rate of return, now, required rate of return can also be called as the opportunity cost of capital. Now, this opportunity cost of capital is nothing but the expected rate of return that an investor could earn by investing, his or her money in financial assets of equivalent risk. So that can be regarded as required rate of return. All these things I have explained in detail in earlier session. Just to brush up, I briefly explained it once again. The next one is the financial decision. Now, regarding this, we haven't yet discussed. Now, this financial decision is the second important function that have to be performed by the financial manager. Now, speaking broadly, the financial manager should and must decide when to, bring in the capital for the organization, which are the different avenues from where can I bring this fund for the organization, how to acquire these funds to meet the firm's investment needs. All these questions has to be answered by every financial manager of a company before deciding how should be the financing of his or her organization be. Now, the main or the central issue before a financial manager is to always decide the appropriate portion of equity and debt. Regarding this, we had spoken the two terms equity and debt. Equity is nothing but the share capital of a company. It could be equity shares or it could be preference shares. It is one way of funding our organization. Now, when we do the funding of the organization with equity, we have its own merits, we have its own demerits. Now, the other source from which we can raise the capital of the organization is debt. Now, debt could be, borrowings from a creditor, from an institution, or from third parties, or also in the form of bonds and debentures. Now, could it be the equity shareholders or it could be the debtor, those who being called as our creditors. Now, both these two kind of people would be giving us fund. They are different from only the terms that equity shareholders would be the owners of the company and those who provide us the debt are regarded as third party for the organization. So when I as a financial manager I have to take decisions regarding finance, I'll have to make an appropriate, proportion of equity and debt structure to my company. Now, this equity and debt structure is regarded as optimum to that point when the cost of capital would be minimum and the rate of return would be maximum. Now, speaking about cost of capital, it is nothing but the expenses that are involved in raising this capital. It could be equity or debt. The expenses that we are going to have it for our organization is called as cost of capital. Okay, and this whatever we are speaking regarding the appropriate portion of equity and debt, that in exact terms is known as capital structure of an organization. Okay, now this one term is very much important when it comes for strategic financial management. Now, this capital structure should always be optimum. Okay, as I said earlier, now every firm's capital structure is considered optimum when the market shares would be maximized or the value of our shares when we deal in the secondary market, or what we call it as shares, we invest, we reinvest, we take it out. Whenever that happens, the value when it goes to maximum, we can regard that our organization is having optimum capital structure. Now, speaking regarding this equity and debt, there are some things that we'll have to keep in mind. Okay. Now, in the absence of debt, what happens is the shareholders' return or whatever the shareholders of the company is going to get, that would be equal to the firm's return. That is to tell, whatever the profit the company is going to get, it would be given for the equity holders. Now, whenever you use debt in an organization, what happens is that it affects both the returns and the risk of the shareholders. That is to tell, there are chances that it may increase the return on equity funds, but it always increases the risk as well. That is to tell, what happens, the equity shareholders are there. Now the entire capital is made only out of equity. So whatever the profit the company is going to get, the entire money would be going for the equity shareholders. Based on how much shares each person has, it would be divided and would be distributed among those. Now what happens is that the company decides to bring in some kind of debt, might be along with the 1 lakh rupees of share capital it has, it might go in for 1 lakh of debt. Now this 1 lakh of debt could be in the form of, bonds. What happens is that whenever you bring in bonds, compulsorily at the end of the term, you'll have to pay interest on that. So now that you will have to pay interest, that would be paid out of the profit. So some part of the profit you're going to get less. That is how the shareholders' return would be affected. Okay. Now the change in shareholders' return caused by the change in the profits. Remember, the change in the returns of the shareholders due to the change in the profit is regarded as financial leverage. Okay. Now this financial leverage, we shall discuss regarding this in detail in coming chapter along with some practical problems. Okay. Now a proper balance will have to be maintained between return and risk. And it goes without telling that when the shareholders' return is maximized with given a risk, definitely the market value per share will be maximized, and thereby the firm's capital structure would be considered optimum. Okay. So that is to tell, for any company to have its optimum capital structure, the situation should be such that at a given amount of risk, the return should be maximized, and when the return is maximized, the value of the firm goes, and thereby the market value would increase. Now, once financial manager is able to determine the best combination of debt and equity, now that financial manager must, find the different avenues to raise the appropriate amount through the best available resource. Now, in practice, a organization, whichever it might be, it considers many factors, okay, many other factors than just debt and equity or than just financial leverage. It does consider how much control it has over the market, what is the flexibility that is there in terms of taking decision, what are the convenient loans that it can get from the market, what are the legal aspects regarding it may be equity or debt. So all these things would be considered in deciding the capital structure we tell capital structure, usually the decision would be considered as financing decision. The next one is regarding dividend decision. Now, as we mentioned earlier, dividend decision is the third major financial decision. Okay, now you have brought in all the necessary funds that is needed for the organization. You have invested it in different other assets of the organization, and you have started working, and it is that point of time when you have even earned the return for your investments. So the financial manager must decide whether the firm should distribute all the profit or retain them, or distribute some portion and to retain the balance. Now, first of all, we should remember that dividend decision can only be taken for the equity shareholders. Okay, because when it comes for debt, you should have already paid the interest. After paying this interest, after paying the tax, whatever remains in your hand, or whatever is called as the fund of the owners of the residue, we are taking dividend decision for that part of money. Should I give it for the equity shareholders, or should I return in the organization? Which is going to prove to be more beneficial when we compare the both? Will I have the profit and reinvest it somewhere, and am I going to increase the money, or will I retain it, the entire thing? Now, the proportion of profit distributed as dividend is called as dividend payout ratio. Okay, that is to tell, in form of dividend, what have I paid out? It is not play out, it is pay out. Okay, and if at all I have decided to retain something, that is called as retention ratio. So you have money, you have decided whether to pay out, whether to retain it. Whatever you have paid out is dividend payout ratio. Whatever you have retained, it is called as retention ratio. Now, when we spoke about financial decision, there it involved debt policy also. That is to tell how much portion of debt should be there in the organization. Now, in the same way, it is expected of every financial organization, I mean financial manager, or every business organization which pays dividend, that the dividend policy should be determined in terms of how it is going to impact on the shareholders' value. Now, how we had a optimum capital structure, even we have something called as optimum dividend policy. Now, speaking about this optimum dividend policy, it is, it is one that which maximizes the market value of the firm's share. So it could be your capital structure, it could be your dividend policy. When you know the difference, the result of the both is just that it will have to increase the value of the firm to the most maximum possible. So if shareholders are not indifferent to our firm's dividend policy, the financial manager must determine the optimum dividend payout ratio. That is to tell, regarding the shareholders being indifferent. That is to tell, if you pay the dividend or if you are not going to pay the dividend, if both the decisions is taken in the same way by your investors, they are being termed as being indifferent towards your dividend decision. That is to tell that they have confidence in your organization and that whatever decision is taken by the organization is accepted well by the investor. So when that happens, the entire responsibility of deciding how much should be the optimum dividend policy goes into the head of financial manager. And usually this dividends would be paid in form of cash. Okay, and there are some time there are also chances that if at all the company wants to further increase its equity shares or further wants to bring in capital to its organization in the form of shares, instead of giving this dividend in form of cash, they can also decide to give it in the form of bonus shares. Now, we had already discussed regarding bonus shares, but let me tell it once again. Now, bonus shares are those shares which would be given to the existing shareholders without any charge. That is to tell, now if I had to give dividend of rupees 10 per each equity shareholder, those who are existing, when I give bonus share, what I do is in form of cash, I will not give, but I would increase one share per each equity shareholders who are already existing in my company. So before deciding anything on these different kinds of dividend decision, it is expected of a financial manager that he should consider few of the questions. First one being, how well will be the stability of giving dividend from my organization, or in simple words, the dividend stability of the organization. He'll also have to consider whether giving bonus shares would prove effective or whether giving cash dividends will prove effective. So now this is all regarding dividend decision. I hope whatever we discussed until now was clear to you all. If at all there are any kind of doubt, please always feel free to ask question. You can unmute yourself and ask question, or just post, draft a message and send it in your WhatsApp group. Now moving forward towards the next decision, it is the short-term financial decision. And we spoke about short-term financial decision. We have one important in that, it is liquidity decision. But before going to liquidity decision, let us discuss some of the characteristics of this short-term financial decision. Definitely, it involves short-term period, that is to tell the time involved would be lesser than one financial year, and here the decision would be taken regarding all those funds which are necessary for maintaining the business in day-to-day terms, or in other words, what we tend to tell as working capital that is necessary for any business organization. So when we spoke about our long-term financial decision, there our assets and liabilities came. That is nothing but our fixed assets and fixed liabilities. So whenever we speak of short-term finance decision, it involves the manage of current assets and current liabilities. Now I had already asked whether you have a very good base of accounts. So, and since you have said, I don't think it is necessary for me to explain once again what is current asset, what is current liabilities, what are its features, and what are the different kinds of current assets or current liabilities. I hope you all know. And speaking regarding the investment avenue, whenever you invest for a short term period, it is called as short term borrowings or short term investment. You can also borrow within a span of 1 year, or you can also invest within a span of 1 year. Now, decisions that would be taken regarding all this would be considered under short term finance decision. Now, your bills payable is one of the example for your short term borrowings. Usually that is one of the main short term borrowings that a business organization does. So speaking further, it is liquidity decision. Now we should always keep this in mind that the investment that we do in current assets, okay, it affects the firm's profitability and the liquidity of the firm. When we spoke about our long-term decision, the decisions we make on the long term affects the profitability and the value of the firm. And when we speak about short term, the decisions that we make affects the profitability and the liquidity of the firm. Okay, so it is regarded that the management of these current assets that affects the firm's liquidity is also one of the important financial function. Okay, now it is expected of every organization that these current assets should be managed efficiently. Now, managing current assets, because and managing it efficiently is necessary for safeguarding the firm against risk. That is the first thing. And the second one is to maintain the liquidity. Okay. Now, liquidity is nothing but the amount of the money that every organization has its in hand for its very disposal. It can be in the form of cash or what we call as near cash or quick cash. Now, quick cash or near cash is nothing but it would be in the form of investment, but it would be very easy to convert it into cash. Now, that is necessary for maintaining liquidity. Now, what happens when liquidity is not there is the organization would go for something called as illiquidity. Okay. Now, this illiquidity can lead to insolvency of any organization. So, in other terms, if I have to speak about illiquidity, it is nothing but lack of liquidity or lack of cash in the hand. Okay, and whenever it is in the extreme situation, the firm will always go for insolvency. Now, it is important to note that there is always a kind of conflict that exists between the profitability and liquidity. Okay, now this decision are to be made for taking decisions regarding current assets, but then there is always will have to decide whether the profitability should be more or whether the liquidity should be more. And whenever there is a clash between these two, it simply means the more the profitability that you want, the less would be the liquidity, and the more the liquidity you want, you will be having comparatively less profit. Now we should always remember that the more the liquidity it is not that there is no profit at all. But when you compare the liquidity position, might be now that you have 40% of liquidity and other situation wherein you have 60% of liquidity in your organization. So when you compare, what happens is, for the firm which is having more liquidity comparative to that firm which is having less liquidity, it is going to have less profit, given that all other situation, or given that all other aspects of the business for both the organization remains the same. Okay, that is when we tell that when profitability is more, liquidity becomes less, and when liquidity is more, profitability becomes less. But speaking about this profitability and liquidity, we should also remember that the organization will always lose profitability because these ideal current assets would not earn anything. That is to tell, liquidity I'll have to maintain, but I'll have to keep in mind that keeping more money in the form of cash is not going to, benefit my organization. It is not going to earn me anything. But if at all I find a place or situation wherein I can invest, it might be profitable for my organization. So it is always recommended that a proper trade off must be achieved between profitability and liquidity. And this ratio of profitability and liquidity is termed as profitability liquidity trade off. How we had decided in dividend decision whether I am going to have a dividend or whether I am going to retain. That is called as dividend retention ratio. And we had one more debt to equity ratio, and this is the third one where we'll be speaking regarding profitability and liquidity. Okay, now the profitability liquidity trade-off always requires that the financial manager should develop, the most efficient techniques of managing current assets of each organization. Now, it is expected of a financial manager that he should estimate, first of all, the firm's needs for current assets. Not only that, he should also make sure that the funds would be made available whenever needed. Because the more you are going to invest, profitability would increase. But whenever the sudden need for cash arise, can I manage it? That question has to be answered in the first. So whenever we speak of all these things, in total, these financial decisions directly concern the firm's decisions to either acquire or dispose of the assets, and it also requires commitment or recommitment of funds on a continuous basis. Now, these decisions that are to be taken by any business organization never would be one-time decision. It will be the decisions which are to be taken on a day-to-day basis. But the time horizon these decisions include on a whole would be different. Some of the decision involves less time period, some of the decisions involve a long time period. But these financial decisions, when becomes whole entirely together. All the types of long term, short term, and the four different, they are taken on a continuous basis. So it is in this sense that the financial functions are always set to, influence the production, marketing, and all other kinds or all other functions of the firm. So, and definitely we can tell that these financial functions affects first the size of the organization, how much should be the size in terms of money or the total amount that is being invested, the growth of the company, the profitability of the company, the risk that is being involved in taking all this decision. And when we collectively speak of all these things, we can tell regarding the value of the firm. So, speaking about financial manager, it reminds me to speak, quote one of the, to quote Ezra Solomon here, who tells why is it important to take proper financial decisions or to take decisions wherever finance is involved. Why should we give so much importance? I quote, the function of financial management is to review and control decisions to commit or recommit funds to new or ongoing uses. Thus, in addition to raising funds, financial management is directly concerned with production, marketing, and other functions within an enterprise. Whenever decisions are made about the acquisition or distribution of assets. So hereby we complete the most important or the first part of your first lesson, wherein we discuss or we try to understand what are the different types of financial decision, what are the things that are being involved when we take such decision, and why is it important for every organization to take such decision very clearly, and what role does every financial manager in the organization is expected to play, and how is it that he is going to affect the firm or the business organization in the large scenario. So let us wind it up for here, and you'll be having one more session at 12 o'clock. Come back to that. We shall discuss the financial procedures and system in detail, and also what are the financial managers' role in business organization. So let me take your attendance, then you can leave. Yes, class, you can leave for that time, and it be back at 12:05. I would send your link.